certainly don't think we've topped out. I mean, definitely we've got a long consolidation here, or a multi-month consolidation. To me, what is most impressive and most impressive about gold is that we haven't had a meaningful decline. I mean, you've got that decline there in May, and then we came right back from it. But we haven't had a meaningful decline in terms of both value and time. We really haven't had one this whole bull market, and that to me has been that just demonstrates gold resilience. Now, in a way we can understand now when we look at who the drivers of the who are the drivers of the gold market, who's been buying and why they've been buying. And if you're looking at obviously the central banks of the world have been the largest buyers of gold for the last 3 years, and they've been buying to diversify their assets away from the dollar in the face of dollar weaponization. And I think it's important for people to understand the central banks were already diversifying away from the dollar for years, but of course, what happened with the Russian assets just stepped that up. Well, we can talk about the economy and broader, and then we can talk about investments. Obviously from the macro point of view, from the economic point of view, the biggest sort of question mark, I think, is when the Fed is going to start cutting rates. Obviously tariffs and everything else that's going on are a big concern or a big issue, and the uncertainty that they lead to and the volatility that they lead to. But from my point of view, how I'm handling things, that's not such a big issue, I think, as the monetary situation, and also the economy. In the US, it strikes me that the economy, and this is becoming clear, I think, the economy is really nowhere near as strong as the Federal Reserve, the government, the media, the headline economic reports, frankly, would suggest. And we saw that very, very clearly with the latest payroll numbers.
The consumer shows both grit and cracks under pressure. Personal consumption rose modestly in June, plus 0.3%, yet savings remain thin. But households are increasingly leaning on credit. Revolving credit edged up, and non-revolving debt climbed even more sharply, a sign that people are borrowing to keep pace. Disparities are evident. Spending is concentrated among affluent groups, while middle and lower income households face mounting bills and rising delinquencies.
That was the most clear example possible, where Jerome Powell, chairman of the Fed, on Wednesday talks about how solid the labor market is, and then Friday we have a jobs revision that basically removes virtually all the jobs created in the last 2 months. So I don't think clearly the jobs market is nowhere near as solid as Jerome Powell thinks. And again, as I say, as the headlines would suggest, but I think that's also true of some of the other aspects of the economy. Consumer spending, for example, even though consumer spending numbers are going up, again, Jerome Powell said the consumer is very solid. I don't know if he'd repeat that. He's probably learned his lesson. But if you look at the consumer spending, yes, the numbers are still going up. But then look at credit card balances, credit card defaults. They're going up dramatically as well. Then you look at anecdotal or listen to some of these recordings, and when firms like Walmart talk about higher income people, going to their stores. When you put all this together, it seems fairly clear that the lower income people are really beginning to struggle with the credit card balances rising and defaults on not just on credit card debt, but we've also got increased problems in automobile loans and so on. And then when you've got higher income people moving down market for their spending, I mean, that's not a very, very solid picture.
Rising tariffs continue warming inflationary pressures, while political moves are shaking confidence in critical institutions. President Trump's dismissal of the BLS chief following revised job data has provoked concern over data integrity. Simultaneously, trade-related costs alongside core CPI trending above expectations are fueling fears of a stagflation-light reality, sluggish growth paired with rising prices and job market softness.
But again, because the higher income people are still spending, albeit at the lower level, and then because you've had the credit cards. I mean,
credit cards are at what, a 13-year high today compared to so more than a decade high.
Yeah, and of course, part of that picture, you look at that as a long term, and you'd say, well, it's not so bad relative to the 90s and the 2000s. But remember, when the great financial crisis hit and the delinquency shot up, the banks started being more cautious about who they were giving credit to.
Right.
So the fact that the delinquency rates and this is delinquency rates, of course, is not the balances. I think if we looked at balances, we'd probably see an even a worse picture, and the graph would be even higher in the sense that, there's people who have balances who used to pay them all off, who aren't paying them off, but they're still meeting their minimums, so they don't come into the delinquency rate. But at any rate, the banks certainly became a little more cautious in who they gave credit to after the great financial crisis. So now we're seeing delinquencies among somewhat better credits.
The Federal Reserve remains data dependent, balancing on the fulcrum of inflation and weakening labor markets. While investors now anticipate 2 interest rate cuts in 2025, optimism is tempered by persistent inflation and institutional gridlock. Fed officials like Michelle Bowman cite tepid job data as a case for multiple rate reductions before year's end. Richmond Fed's Tom Barkin warns consumer behavior will be pivotal for shaping inflation and job dynamics ahead.
The other aspect to look at with consumer spending, of course, is just break down what they're spending on, and discretionary spending has gone down quite a lot, and long-term durables have gone down quite a lot. So again, that's all a reflection that the consumer's not quite as strong as it would appear. Anyway, I've rambled on about that long enough, but I mean, I think to me it's very clear that the economy is not as strong as it would appear. That's definitely something that we're watching carefully. And then what follows from that is, when will the Fed be cutting rates? That was the big question all year. I think it's sort of been answered for us now, but unless something really dramatic happens in the next month, the Fed is going to cut rates in September. And I think, and the Fed funds futures rate is certainly bet in that way, with over 90% probability of a rate cut in September. So the big question is, we assume it'll only be 0.25%. I mean, it would be a shock to me if it was 0.5%. It'll probably only be 0.25%. So the big question now is, what's the commentary around that, both in statement and in Powell's press conference afterwards? I certainly don't think we topped out. I mean, definitely we've got a long consolidation here, or a multi-month consolidation. To me, what is most impressive and most impressive about gold is that we haven't had a meaningful decline. I mean, you've got that decline there in May, and then we came right back from it. But we haven't had a meaningful decline in terms of both value and time. We really haven't had one this whole bull market. And that to me has been, that just demonstrates gold resilience. Now, in a way we can understand now, when we look at who the drivers of the, who are the drivers of the gold market, who's been buying and why they've been buying. And if you're looking at obviously the central banks of the world have been the largest buyers of gold for the last 3 years, and they've been buying to diversify their assets away from the dollar in the face of dollar weaponization. And I think it's important for people to understand the central banks were already diversifying away from the dollar for years. But of course, what happened with the Russian assets just stepped that up.
Amid economic uncertainty, central banks are turning heavily to gold as a stabilizing force. In Q1 2025 alone, central banks acquired over 244 metric tons of gold, while gold ETFs attracted an unprecedented $30 billion in inflows. Most expect this trend to continue. The World Gold Council reports 95% anticipate boosting gold reserves over the next year. Even as Q2 buying tapered, overall additions remain well above historic norms.
Accelerated that move. But this is a long-term move. It's not something that just happened recently, and it certainly just didn't happen this year since President Trump came in. It's a longer-term move. It seems to me that when you look at the buying of the central banks over particularly, let's say, the last 3 years since the Russian asset seizure, there's really no reason to think that that's going to slow down anytime soon. And so in that sort of light, it's really not surprising that any decline is met with new buying fairly quickly. I mean, we have ebbs and flows. We had China was out of the market for like 4 or 5 months. Now in July, they just bought for, I think, the 8th month running. So you have other countries that come and go, but overall, it strikes me that there's still a lot of buying to come from the central banks. You know, you look back to the beginning of the century, 1999, and the dollar represented about 75 to 80, somewhere in that range, 75 to 80% of all global central bank foreign reserves. And that was down to about 65% 5 years ago. Again, I emphasized before the Russian asset seizure. And now it's accelerated down to around 47%. And this is even as dollar reserves are growing, or the amount of dollars around are growing. The amount of dollar, as we know, the trade deficit with the US trade deficit is very high, which means that foreign countries are earning more dollars. So they're continuing to earn dollars.
Gold's allure extends across the globe. China continues its uninterrupted gold buying streak. July marked the 9th straight month, valuing its holdings at around $244 billion. New research exposes a troubling undercurrent: illicit gold mining to fuel China's strategic accumulation, particularly in nations like Indonesia, raising environmental and governance alarms. This divergence from U.S. dollar assets underscores a broader reshaping of reserve strategy, a shift from volatility towards stability.
But they're now getting rid of them, if you like, sooner than they otherwise would have done, and the percentage is now down to around 47.5%. Gold has moved up, replacing the euro as the number $2 foreign reserve asset of central banks. It's about 22%. 22% is moderately high, but of course it's a lot lower than it was 60 and 70 years ago. And of course, there's some countries that have high gold reserves. There's still a lot of countries that are at 2, 3, 4, 5%. So I think there's a lot of potential for central banks to continue to increase their holdings of gold, and that's what's going to really drive the gold. That's what has been driving the gold market. Now, if you look at the North American investor, particularly the US investor, they've been kind of lukewarm on physical gold and actually negative on gold stocks. Maybe we'll talk about that later, but with regard to gold. And again, there's a logical reason for that, because the sort of economic factors that typically drive US investors towards gold, namely a weak economy, low and declining interest rates, high and increasing inflation, and a weak dollar, they really hasn't been the environment that we've been in for the last several years. obviously the dollar has been weak this year, but it's only been relatively weak. I mean, if you look at the dollar on a 5-year basis, it's not, so nobody would say it's super weak.